Wall Street is buying gold, Canadian manufacturers are stalling out, and consumer confidence just round trip back to Liberation Day panic levels. This time without tariffs as the excuse. Something is shifting in the Canadian economy. Let's get into it. Welcome to the Daily Brief Canadian Macro. I'm Steve. Before today's creators, here's where Canada's economy actually stands heading into Q2. Because the data tells a more nuanced story than the housing-focused commentary you'll hear in most places. GDP grew 0.1% in January, and the advanced estimate has February at 0.2%. So Q1 is tracking slightly ahead of what the Bank of Canada expected. The bright spots, oil and gas, construction, and retail, posted back-to-back gains in January and February for the first time since late 2024. But manufacturing is the warning sign. After 11 straight months of contraction through 2025, it briefly turned the corner. PMI hit a 13-month high of 51 in February. Then March came in exactly at 50 flat. Production declined for the first time this year. Export orders fell for the 14th consecutive month, and input costs hit their highest since August. Mostly fuel costs from the Iran war flowing through the supply chain. On jobs, Canada added 45,600 payroll positions in January, then gave back 84,000 jobs in February. Unemployment is at 6.7%. Wage growth is running at 2% year over year, positive in real terms, but just barely. The CUSMA review starts July 1st. The April 29th rate decision is the next Bank of Canada marker, and roughly 1 million mortgage holders renew this year into payments averaging 20% higher. And that's the macro backdrop. Now here's what the creators are saying. Robert Gottlieb on the David Lin Report argued gold is entering a structural bull market, and his case is more grounded than the typical gold pitch. He starts with a striking data point from the World Gold Council that less than 1% of global investable assets are currently allocated to gold. He then points to Morgan Stanley CIO introducing a 60-20-20 portfolio split in Q3 2025, breaking the traditional 40% bond allocation into 20% bonds and 20% gold. If other institutions follow that lead, even a small reallocation means massive flows into a relatively small market. He also reads recent ETF outflows, over $1 billion from SPDR gold shares, as momentum traders unwinding, not a fundamental shift away from the metal. Now, it's worth noting that gold is already near all-time highs. A lot of the de-dollarization narrative is already priced in, and gold pays no yield, which matters when rates stay elevated. So the bull case is real, but it's not without risk. For Canadians specifically, this is also a domestic equity story. Canada is a top global gold producer. If Gottlieb's right about sustained institutional demand, Barrick and Angelico Eagle, along with Kinross, are the direct play, not just the metal themselves. Over on Run Butler's channel, Sam Cooper detailed the Vancouver model, and it needs some context to understand why it all matters. Cooper documented how drug cash moved through BC government casinos in the early 2010s. Justice Cullen's commission found $1.2 billion in large suspicious transactions at a single Richmond location in 2014 alone. Cash came in dirty, but left as clean government checks, then flowed into real estate through development schemes and third-tier mortgage lenders. This isn't the primary driver of Vancouver's current struggles, though. Regulatory reforms followed the Cullen Commission. What Cooper's history explains is how a decade of artificial demand, capital that had nothing to do with local incomes, inflated prices to levels that can't easily reset, and sellers remain anchored to peak values. That structural overhang is what makes Vancouver's correction slow and painful, even after the laundering stopped. Well, let's talk about something most Canadian macro channels aren't covering, the manufacturing PMI. The data for March tells you a lot about where this economy is actually heading. Quick context for anyone unfamiliar, PMI stands for Purchasing Managers Index. 50 is the line. Above it means expansion, below it means contraction. It's one of the fastest leading indicators we have because purchasing managers are literally the first people in a company to see demand changing. Canadian manufacturing spent 11 straight months below 50 through 2025, the longest contraction since the pandemic. Then January came in at 50.4, first expansion in a year. February further climbed to 51, a 13-month high, with new orders growing and employment rising at its fastest pace in over a year. It looked like a genuine turn. Then March dropped back to exactly 50 flat. Production declined for the first time in 2026. Export orders fell for the 14th consecutive month. Input costs hit their highest level since August, mostly fuel flowing through from the Iran oil shock. Supply chain delays worsened, with firms explicitly citing Middle East shipping disruption. Canadian manufacturers got cautiously optimistic in January and February, started hiring and ordering again, then walked straight into a wall of higher costs and U.S. tariff pressure, just as they were rebuilding confidence. The sectors that need rate relief are not the same sectors driving inflation. The Bank of Canada can't really solve both problems at once. The next PMI print covering April drops in early May, right around the same time as the February GDP official release. If we're still at or below 50, the 2-month recovery starts looking like a head fake rather than a real inflection. Here's the data point that should probably worry Canadians more than anything else right now, and it came out just this week. The Bloomberg Nanos Consumer Confidence Index dropped to 46.93 for the week ending April 3rd. That's an 11-month low. Below 50 means net negative sentiment. The expectations component, how Canadians feel about where things are headed, has lost nearly 10 points in 4 weeks. Just 15% of Canadians now believe the economy will be stronger 6 months from now. 4 weeks ago, that number was 27%. To put that in context, the last time confidence was this low was May 2025, when Canadians were still absorbing the initial Liberation Day tariff shock. We've essentially round-tripped back to peak panic levels, this time driven by the Iran oil price spike rather than the tariffs directly. Why does this matter beyond the headline? Because consumer spending accounts for roughly 55% of Canadian GDP. If households are this uncertain, the retail resilience we saw in January and February, those back-to-back gains that had economists cautiously optimistic, is probably not going to hold in Q2. It also puts the trade picture in sharper focus. Canada's trade deficit widened to $5.7 billion in February, the worst reading since August 2025. Our surplus with the US shrank to just $1.7 billion, the lowest since May 2020. And here's a detail worth noting. A big chunk of February's import surge was Canadian institutions buying gold from the US, which brings Gottlieb's thesis full circle. Institutional money is moving into gold, and some of it is flowing south across the border to do it. But here's the through line. Canadian households are caught in a compressed macro moment. Rates are on hold not because things are good, but because the bank can't cut without risking inflation, and they can't hike without crushing a weak economy. 1 million mortgage renewals are hitting at payments 20% higher than expected, and the trade agreement underpinning 90% of our tariff-free U.S. exports is up for renegotiation in July. Against that backdrop, Gottlieb sees institutional gold flows that benefit Canadian producers, and the trade data confirms that money is already moving. The manufacturing PMI shows an economy that tried to turn the corner in January and February, then ran into the Iran oil shock at exactly the wrong moment, all while consumer confidence has round-tripped back to the Liberation Day lows, which puts the Q2 spending outlook in real doubt. The common thread is uncertainty itself here. Manufacturers, consumers, and mortgage holders are all in the same waiting room, watching the April 29th rate decision, the Kuzma negotiation, and the Iran situation for signals on what comes next. The next 90 days will tell us more about Canada's economic direction than anything that happened in Q1. That's your daily brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.